So picture this. You finally do the responsible thing. You buckle down, you stay super disciplined, and you start saving money every single month. You stash away $100 here, maybe $200 there. You're feeling incredibly good about it. And hey, you absolutely should. Eventually, you hit a real milestone. You open up your banking app and boom, you see $10,000 sitting right there in your savings account. You feel totally financially mature. But then, you realize something kind of strange. That account, it's earning a measly 0.5% interest, which means after an entire year of leaving that money completely untouched and being perfectly disciplined, you've made a whopping $50. Yeah. Meanwhile, you keep hearing everyone around you talk about investing, the stock market, and compound growth. Suddenly, you start wondering, wait a minute, am I doing this all wrong? Well, welcome to this explainer. Today, we're going to take your stagnant savings and show you the exact step-by-step path to turn them into actual, real wealth.
We've got a great roadmap for you today, broken down into 5 key areas. We're going to cover the saver's dilemma, the math of wealth, the psychology hurdle, the 5-step path, and finally, weathering the storm. By the time we wrap this up, you'll know exactly how to transition into investing without feeling overwhelmed or risking your basic financial security.
Okay, let's dive into this. Section 1, the saver's dilemma. Here is the slightly controversial truth we need to start with. Savings protect your money, but investments actually grow it. Saving alone just isn't enough to get you to the finish line. Which brings us to Section 2, the math of wealth. Let's look at the pure logical numbers of savings versus investments. You have to see this dramatic visual disparity between these two paths. Let's imagine you keep that $10,000 in a typical savings account earning, say, 1% interest. After 20 years, as you can see right there, you're sitting at about $12,200. I mean, it's not terrible, but it's certainly not life-changing, right? Now look at that second option. Historically, the S&P 500 stock market has returned about 10% per year on average over long periods. If that exact same 10 grand earned a 10% return, after 20 years, it turns into roughly $67,000. It's literally the exact same starting money, but the outcome completely shatters what you'd get from a savings account. You see, the biggest wealth gap out there isn't usually between people who save and people who spend. It's between people who save and people who actually invest. Section 3, the psychological hurdle. Let's talk about why we fear investing. Because honestly, if the math is so obvious, why doesn't everyone just do it? It's the emotional fear of seeing your money drop 5% on a random Tuesday. And that leads us to Section 4, the 5-step path. Look, if you're terrified of losing the savings you worked so hard for, I completely validate that. That fear is incredibly fair and totally normal. That is exactly why this transition shouldn't happen all at once. It has to happen safely, in stages. Let's move to and see how this builds. This is our complete, actionable roadmap. These 5 steps will safely walk you across the bridge from the old paradigm of just saving to the new paradigm of investing. We're going to build an emergency fund, create mental buckets, start small, stick to simple investments, and stay disciplined. So, step 1 is absolutely foundational. Before you invest a single dollar in the market, you need a real emergency fund. We're talking 3 to 6 months of living expenses safely stored in cash. This money strictly stays in your savings account. It's not for investing, and you definitely don't use it to jump on some hot market opportunity. It is strictly for unexpected problems, a sudden job loss, a medical emergency, or the car breaking down. What most people completely miss is that the biggest reason investors panic and sell is because they suddenly need cash. So this emergency fund effectively protects your investments from your own life. Now, what's really interesting about this slide is how this concept solves that whole psychology hurdle we talked about a minute ago. Step 2 is to mentally separate your saving from your investing. I want you to think of them as 2 totally different buckets. Bucket 1 is your safety money. It just sits there, it doesn't move. Bucket 2 is your growth money. And because its entire job is to grow over decades, it is allowed to fluctuate. Visually separating these mental buckets gives your investments permission to go up and down. And let me tell you, that dramatically reduces your anxiety on a day-to-day basis. All right, step 3, start small. So many beginners think that to be a quote-unquote investor, you need thousands of dollars just sitting there ready to go. You really don't. Plenty of brokerage platforms let you start with just $50 or $100. At this early stage, your goal is not to make massive profits. The goal is simply building the habit of contributing money. Building that habit matters so much more than trying to perfectly time the market. Moving to step 4, and this is where we avoid the biggest beginner trap out there. Focus on simple investments first. Far too often, new investors jump straight into super complicated strategies, day trading, options, wild crypto speculation. Please don't do that. The simplest investments actually outperform the complicated ones over time. A perfect example?
Index funds. Instead of trying to guess and pick one winning company, an index fund just tracks the overall stock market. You're buying tiny pieces of hundreds of successful companies all at once. It gives you immediate diversification, way lower risk, and reliable long-term growth. And hey, if you're worried that keeping things simple means you're doing something wrong, look no further than this. The legendary investor himself, Warren Buffett, has repeatedly recommended low-cost index funds for most everyday investors. It turns out the most powerful investing strategy is actually pretty boring, and even the world's most successful investors totally agree on that point. It takes the fear out of feeling like you have to be a Wall Street genius.
That brings us to step 5. Stay disciplined and let compounding work its magic. Consistent investing is what separates true wealth builders from gamblers. Let me set up a really compelling example for you. Imagine you invest just $300 a month into the stock market. Not a crazy amount, right? Well, if the market averages an 8% return per year, after 25 years, you'd have roughly $285,000. But think about what you actually put in. Out of your own pocket, you only contributed $90,000 over those 25 years.
So where did the rest of the money come from? Right here, $195,000. That massive number is purely investment growth. That is quite literally free money, generated entirely by compounding working in your favor over time. Isn't that wild? Now, right as you start to feel really confident, right as you look at those big numbers and feel ready to jump in, we have to address the elephant in the room, the one massive question that stops almost every new investor dead in their tracks. What if the market crashes right after I start?
Which brings us to Section 5, Weathering the Storm. So the crucial point is we have to completely change how we view market downturns. Market crashes aren't disasters. They are normal, expected features of investing. Believe it or not, long-term investors actually benefit from them because when markets drop, your consistent monthly contributions are suddenly buying way more shares at much lower prices. It's essentially a massive sale.
And this brilliantly illustrates the entire paradigm shift we've been talking about today. Saving money is like storing seeds in a glass jar. You are protecting them perfectly, nothing bad will happen to them, but absolutely nothing is ever going to grow. Investing, on the other hand, is like taking those seeds and planting them in the dirt. At first, it just looks messy. You don't see results immediately. It might even look like you ruin them. But over time, things take root, they grow, and eventually you have something incredibly powerful and far bigger than those original little seeds you started with. To summarize this entire journey for you, most people eventually learn that saving money gives you stability, but investing gives you actual freedom. They are two totally different tools meant for two completely different jobs. The earlier you can combine the solid, comforting stability of your savings with the boundless freedom of your investments, the more undeniably powerful your financial future becomes. I want to leave you with this final thought today. Ask yourself honestly, are you currently stuck in the saving stage, just protecting your seeds in a jar, or have you already started investing and planting them in the soil for the future? Take a moment, think about your own journey, and decide what your very next step needs to be today.